Welcome back, Focus Learners. We all love the on-pitch drama. But today, we're looking at where the real game is played, the balance sheets. We're going to uncover the hidden financial machinery, those complex accounting standards, and the heavy tax burdens that operate silently behind the world's absolute biggest sports trades. It's going to be a fascinating ride, so let's get right into it.
Okay, let's dive into this. $222 million. I mean, wow. That was the staggering transfer fee Paris Saint-Germain paid to acquire Neymar from Barcelona back in 2017. Literally, $250 million for a single human being. It completely shattered records, right? It sent shockwaves through the entire sports world. But think about it from a strict business perspective for a second. How do you actually account for an expense like that? Where does that massive number even go on a corporate financial statement?
And the Neymar deal wasn't just a one-off. It lit a match. Following that trade, European football transfer activity absolutely skyrocketed. We're talking about a jump from an estimated 3.2 billion euros in the 2014-2015 season, doubling to a massive 6.4 billion euros by 2017-2018. We are dealing with massive multinational corporate finance here. This isn't just a game anymore, it's a financial juggernaut.
Here is our roadmap for today's explainer. 1. The million-dollar question. 2. Owning the registration rights. 3. The IPL expense model. 4. Crucial contract constraints. 5. The taxman always wins. And 6. The final scorecard.
Section 1. The million-dollar question. Are players human capital or expenses?
So how do franchises actually put a balance sheet value on a human being? While standard accounting rules heavily hesitate to recognize human capital as an asset, and the reason is pretty straightforward, you can't literally own a person. A standard employment contract just doesn't give you the absolute control that accounting standards demand. Plus, there is immense uncertainty in sports. Players get injured, they get sick, they might just lose their touch. And on top of that, you have massive measurement challenges. How do you reliably stick a monetary value on raw talent, skill, or future potential? Standard accounting basically looks at that and says, yeah, no, you generally can't.
Section 2. Owning the registration rights, the European football method.
Right, so if you can't own the human, how does European football creatively get around this? They use a brilliant workaround called players' registration rights. Now, this is a totally crucial distinction to keep in mind. Football clubs are not buying the person. Instead, they are acquiring an intangible asset, specifically the federative rights and the license to use that player in official competitions. When a club pays one of those massive transfer fees, they're actually capitalizing the cost of acquiring this intangible license. It's a move guided by very strict IAS and IFRS accounting standards, and it's tied directly to the timeline of the player's employment contract.
And this brilliantly illustrates just how massive these intangible assets really are. When you look at the balance sheets for some of Europe's top clubs, the numbers are mind-blowing. Player registration rights make up a staggering 41% of total assets for AS Roma and an incredible 43% for Juventus. Think about that. These clubs are essentially just vast portfolios of intangible licenses. It is literally the lifeblood of their financial valuation.
Section 3. The IPL expense model. A tale of two pitches.
Let's switch gears and step off the football pitch onto the cricket oval, because the contrast here is super fascinating. In UEFA football, like we just saw, the transfer fee is an intangible asset, and it's amortized or spread out over the life of the contract. But in the IPL, it's a totally different ballgame. An IPL franchise doesn't buy registration rights in that same way. They essentially own a fixed-term contract for the player. Because they don't own the player rights as an intangible asset under Indian accounting standards, those massive, splashy auction prices are actually treated as a prepaid expense.
To really see how this hits the books, let's put some numbers to it. When PSG signed Neymar for $222 million on a 5-year contract, they did not take a $222 million hit in year one. They amortized it. That means their accounting hit is $44.4 million in amortization every single year for 5 years. Now contrast that with the IPL. Say Royal Challengers Bangalore buys Josh Hazelwood for 12.5 crores on a 3-year contract. Since this is a prepaid expense, each year 4.17 crores is simply transferred from the prepaid expense account straight to the profit and loss account. So both sports spread the financial burden out over time, sure, but the accounting engine under the hood is vastly different.
Section 4. Crucial contract constraints. The rules of the game.
Of course, all this beautiful, neat mathematical division only works if the real world actually cooperates. What happens if a player suffers a severe, career-ending injury?
Well, under international standards like IAS 36 and Indian standards like INDAS 36, teams have to run an impairment test. A short-term injury might not wreck the math, but a permanent injury means the future economic benefits are just gone. If that happens, the remaining unamortized balance, or that remaining prepaid expense, is completely written off. Bam. Immediate heavy toll on the profit and loss account. And honestly, that is exactly why these franchises carry such massive insurance policies. Let's move to and see how this builds across a player's life cycle. Step 1, the multi-year contract is signed and the asset is registered. Step 2, that asset value depreciates strictly over the duration of the contract. But Step 3 is where it gets incredibly risky for the club. At expiry, the player becomes a free agent. And finally, Step 4, the accounting value drops completely to zero. The player is now legally free to negotiate with any other club, and the original club receives absolutely zero compensation. This whole free agent dynamic, which really blew up after the famous Bosman ruling in European football, massively shifts the bargaining power right back to the players.
Section 5. The taxman always wins. The ultimate plot twist.
Okay, now we pivot to the final, incredibly high-stakes hurdle of the sports trade market. You've navigated the accounting, you've survived the contract lifecycle, but if you actually make a profit trading a player, oh, you better believe the government wants its cut. Let's look at the IPL again. Players are generally bound by 3-year contracts, but the rules do permit franchises to trade players during specific transfer windows. If a team owner manages to sell a player to another franchise for more than they effectively owe on the contract, they've just generated a profit. And we all know, where there is profit, there is taxation. But here's the wild part. Exactly how much tax they pay relies entirely on how the government classifies that specific trade.
Vikas Vasal, a partner over at KPMG, really hit the nail on the head here. He noted, in respect of transfer of different rights, the taxability would depend on classification and nature of the transaction. And guys, there is intense, ongoing debate among tax experts about this. Think about it. Is trading a human athlete's contract just a normal, routine business transaction? Or is it the sale of a long-term investment asset? So, the crucial point is this massive financial difference right here. If the tax authorities look at trading players as regular, day-to-day business operations, like a retail store selling inventory, that profit gets hit as pure business income. And in this context, that means a heavy 30% tax. But if the team can successfully argue that the player's contract was a long-term asset held for investment, it could be subject to long-term capital gains tax, which sits much lower at 20%. That 10% swing on a multi-million-dollar trade, that is a massive, massive sum of money. It makes the tax strategy off the field just as critical as the strategy on the field.
Section 6. The final scorecard. Wrapping up the financial game.
Wow, okay, we've covered a ton of ground today unraveling this incredibly complex web of sports finance. Let's do a quick recap. First, European football relies on IAS and IFRS standards to capitalize player registration rights as multi-million-dollar intangible assets. Second, the IPL and cricket flips the script, treating those massive auction fees as prepaid expenses instead. Third, in both systems, the strict physical and legal limits of the contract totally dictate the timeline for how costs are amortized or expensed, eventually dropping to zero when a player hits free agency. And finally, if a franchise dares to trade a player for profit, their ultimate financial victory hinges entirely on that fierce tax classification debate. Are they taking a 30% business income hit or scoring a 20% capital gain?
Which leaves us with one final overarching thought for you. As these transfer fees balloon into the hundreds of millions of dollars, and athletes' contracts are literally amortized, impaired, and traded for capital gains, just like traditional stocks and bonds, is it time we fundamentally rethink how we account for the true economic value of human capital? I guarantee you, the next time you see a massive sports trade break the news, you'll be thinking about the accountants and the tax authorities working feverishly behind the scenes. Thanks for joining me on this explainer, focused learners. Stay curious, and I'll catch you next time.